In this video, we're going to talk about some of the different benefits of mutual funds. In a prior video or prior lecture, we talked about how mutual funds work, but we didn't get into really some of the advantages, although some of those can be inferred based upon how they're structured. Now, just as kind of a refresher on how the mutual fund process works, if you're a little unfamiliar, we've got several parties involved. So the first of which is we have investors and we have what we call the mutual fund. And so investors, as you know, are interested in putting their money into some type of vehicle that's going to grow it over a period of time. Every investor has a different level of risk tolerance, a different time horizon, which means they're okay with more or less risk depending upon their situation. And they have a different time horizon, which means that some investors are looking to get their returns within a year or two. Some investors are okay delaying those returns, potentially maybe for retirement, which could be 20 to 30 years out. But for whatever reason, or regardless of their time horizon or risk tolerance, they're certainly interested in growing the amount of money they have. The other party we have involved is the mutual fund. And the mutual fund is the entity that essentially acquires ownership in different companies. And so instead of the investor working around this process and building out, let's say, a different portfolio by purchasing stocks such as AT&T or Apple or Google or maybe even Coca-Cola, and going through all those transactions, the mutual fund will actually go ahead and acquire those themselves. And it will hold a broad portfolio or broad basket of goods. The investor then can just purchase the mutual fund, and so it's a simpler transaction. So there are a couple of benefits to this arrangement, although this is a pretty simplistic example, but there are a couple of benefits to this kind of arrangement. The first thing, and probably one of the most significant for mainstream investors, is you receive what we call instant diversification. Now, in order to really have a well-diversified portfolio, you would need to acquire hundreds of different stocks across many different asset classes, across different risk levels, and this would take a lot of time, not to mention you'd pay a transaction fee every time you would acquire those goods. The other problem, it comes in what we call rebalancing, which means if you want to hold, let's say 90% of your portfolio in stocks, with the other 10% in bonds, which is more of an aggressive kind of asset allocation, and the stocks perform really well, you might get into a situation to which your asset allocation is now 95% stocks and 5% bonds, if those stocks appreciate in value greater than relative to bonds. And so you would have to go through the process of finding out which of the investments you're going to sell so you can bring this back in line with your original asset allocation. This takes a lot of time, and most mainstream investors don't want to spend that time. So instead, what you can do is purchase the mutual fund. And that mutual fund will give you broad access to all the different securities that are listed in the fund. And ultimately, you don't have to worry about that. And so you've got exposure to a broad different variety of assets, from telecommunications to consumer staples, consumer durables, technology, and so you're not going to be negatively affected if any one of those performs poorly. Conversely, if you were to take a strategy and invest, let's say, in one stock, and so you say you invest in the stock that you own or that you work for, that company, and let's say that's Coca-Cola, and so all of your investment is in Coca-Cola. Well, what happens is those upward and downward swings, you feel those very significantly because everything that you're investing is in Coca-Cola. But if you had a mutual fund that maybe had a small percentage exposure to Coca-Cola, let's say 5%, well, if there was a huge downturn and Coca-Cola had some issues with regards to profitability or something, then your whole portfolio wouldn't be that negatively affected, right? It would certainly feel the impact. But typically in a well-diversified portfolio, you really want no more than 5% of your investment in one particular security, right? So if you look at all of your investments, not one of those investments, whether it be AT&T, Apple, Google, or Coca-Cola, should be greater than 5%. Otherwise, what happens is if one of those companies performs poorly, that brings down the entire return of your portfolio. Now, The counter to that, of course, is if there's a big upswing, you don't realize that as much. But ultimately, investing generally for most mainstream consumers is all about investing over a long period of time. And by doing that, you want to maintain a certain level of return. You want to minimize the downswings, have a very stable return over a period of time. And mutual funds can be a really good vehicle for that, assuming that the objectives of the mutual fund are in line with your personal investment objectives, which is really important to evaluate the funds to make sure that what they invest in and how they invest is consistent with your own personal philosophy regarding investing. But the ability to get this instant diversification is a huge benefit for mutual funds simply because of the fact that with doing some research and making a couple of purchases, we can get broad exposure to a variety of different assets very quickly without doing a lot of the legwork. Now, the other benefit to mutual funds is you receive what we call professional management. And every mutual fund has what we call a fund owner, or a fund manager rather. And that fund manager is responsible for executing all of the buying and selling for everything that's held inside the mutual fund, which is this kind of basket of goods here. Now, every mutual fund rather, I mentioned, has goals and objectives, which means the manager is executing buying and selling based upon what the goals and objectives are of the fund. And if they're not doing that, then obviously that can lead to a huge divestiture from the fund, and people can take their money and go to another fund that's being consistent with its goals and objectives. But the value here is that this fund manager typically has some kind of formal education. Most commonly, we see MBAs in finance that become mutual fund managers, typically have good formal training, sometimes from very prestigious universities, thinking Harvard, MIT, those types, and usually have quite a bit of experience. Typically, you see at least 5+ years of investing experience in some capacity. And so again, although your situation might be different, for the average mainstream investor who's not going to invest a whole lot of time into this, we can leverage some of the experience and some of the skill set of the fund manager. And now we're relying on them to obviously make trades. Now, of course, this can be a bad thing, right? And some of you that are like, well, I don't want to give up control of my investment, which I totally get, are thinking, why would I hand over money to somebody else? And this goes back to, well, you have to evaluate their track record. And so what you can do for every fund is you can look up the prior year's performance, right? You can look up 1-year performance, you can look at 5-year performance, and then 10-year performance. And usually what you're looking for is you want to see a positive return over a period of time. Be very careful of just looking at the 1-year return, because it could have been that the stock market as a whole rebounded and therefore everybody made money, right? So after the recession in 2009, everybody that next year did really, really well. You didn't have to be smart to make money because everything increased in value. But during downturns, that's when you can really tell the individuals that are very aware of macroeconomic factors and are very good at making decisions on where to put money to minimize some of that downside risk. So I encourage you to take a look at the entire track record over the 10-year period to see if that person has been making good decisions and if that person has been getting a return, which is ultimately their goal and objective. So those are some of the benefits of mutual funds. Again, it's ultimately a personal decision as to which mutual fund you go through, but in general, receiving instant diversification, receiving professional management is a benefit for a lot of consumers. One thing I'll say as we wrap up here is that this professional management comes with a price, and that typically comes in the way of what we call an expense ratio. Every mutual fund has an expense ratio. This is what you pay as a percentage of what you've invested to the fund manager for their expertise and their time. And you want to be really careful of what you're paying as an expense ratio, because if you're paying a, let's say, 2% expense ratio, and you've got returns of 9%, well, ultimately, your actual return is more like 7%. And so that's something to consider, because that's part of the return that you're not going to get access to. So one thing to consider with professional managed funds is because they're what we call actively managed, which means someone is engaging in buying and selling on a regular basis, that makes the expense ratio higher because we have to pay for the transactions that come out of there, and we're paying for the time and the expertise of the fund manager. Regardless, mutual funds can be a great on-ramp into investing because they allow us to get into investing with not having to become experts and ultimately leveraging some of the expertise of people in the industry. Thanks for checking out this video. If you learned something or enjoyed it, please like and share, and of course subscribe so you can get updates on additional content in the future.